Welcome to Café on Tampa online. Today, we're really privileged to have Mike Chriszt, who is with the Federal Reserve Bank of Atlanta. Mike, tell us about yourself and the bank.
Thanks, Bill. Thanks for having me. Hope you're doing well. Hope everybody watching is staying safe and healthy. I'm the Vice President of Public Affairs at the Atlanta Fed, a position I've been in for 7 years now. And for 20 years before that, I was in the research department at the Atlanta Fed. And the last thing that I did in that role was work on the regional team. So had the opportunity to come to Tampa several times. Actually been down there not only for work, but with my son who plays travel lacrosse. Always going down there in the end of December for a big tournament was always something we look forward to. So,
do you play at the University of Tampa?
We played at a complex that's a little bit north of town, but
Okay.
yeah, the University of Tampa is one of the places that my son has hopes of playing at someday. So maybe
Cool.
I'll be down there a lot more often than I have.
Yeah, we hope so. Yeah, please. Atlanta's a great city, but Tampa and Tampa Bay are great too. And then you all have a small office in Jacksonville too? Is that right?
Yeah, we have branches. We actually have 5 branches throughout the Southeast. The Atlanta Fed is one of 12 reserve banks around the country. We're working with them, of course, and with the Board of Governors in our response to the COVID pandemic. But we have a branch in Jacksonville. We also have a branch in Miami down in Florida. But the way that the Florida is divided among our branches there, our team in Jacksonville actually comes over to Tampa quite a bit.
And can you tell us, for anybody who doesn't know, tell us about the Federal Reserve and the regional offices?
Sure. So
banks.
we just commemorated our 100th anniversary a couple of years ago. We're the Central Bank of the United States. Congress has given us several roles. Chief among them is to work to maximize employment, keep prices low and stable, and to work to keep the financial system stable as well. So as you can imagine, those jobs or those directions that Congress has given us have taken on quite a bit of importance over these past several months.
And for anybody who hasn't taken an economics class, can you just tell us the basic tools that the Federal Reserve uses?
Sure. The most basic and the one in normal times that people are probably most familiar with is called the federal funds rate. And that's a rate that the Federal Reserve has the most influence over. It's short-term overnight lending rate that banks lend money to each other overnight, but that rate influences other rates. So when the Federal Reserve raises rates, for example, you and I feel that in mortgage rates go up or credit card rates could go up. And opposite, if we lower rates, those rates that eventually are consumer interest rates fall as well. So we have influence on the interest that you and I pay on everything that we take a loan out of.
Yeah, and I'm sure most people watching or people will be watching later will know this, but there's always a lot of anxiousness or predictions about what that rate will be. And can you just explain again, being a basic economic theory, why would in general the bank raise the rate and why would it reduce the rate?
Sure. So in times when the economy is very strong, the Federal Reserve tends to increase interest rates to make sure that inflation stays low. There's been several periods throughout history. Most recent in our own history was in the 1970s, where interest rates stayed very low and inflation started to increase quite a bit. Those of you who remember the Paul Volcker years at the Federal Reserve, the Fed actually increased its short-term rate, the one I referred to a few minutes ago, over 20% to get inflation under control. Inflation is not one of the things that the Fed is concerned about. It's, of course, economic growth. And in response to that, what's happened in the economy over the past several months, the Federal Reserve has lowered its short-term interest rate to close to zero and been very, very forthright in communicating that it is very likely to stay at that level until the economy starts to recover from what it's going through now.
And some central banks around the world have implemented negative rates, correct? And what's the likelihood of that?
Right now, based on what our president, Raphael Bostic, has shared, his thoughts on negative interest rates, and Chairman Powell at the Board of Governors has also voiced his concern with regard to negative interest rates. We don't see that as a tool that is likely to be used in the near term. There's just too many downside risks to going negative when the economy of the United States and the financial system of the United States has so much influence around the world. Smaller countries would be able to do something like that and test and see how it works. But in our case, we just don't see that as being a tool that's likely to be employed anytime soon.
What would happen to consumer rates if that rate went negative?
That's a great question. And there's research on that topic that some of it says there really wouldn't have any big impact on consumer rates because if you're a financial institution, your ability to turn a profit or stay in business, negative interest rates is very, very low. So the whole model really doesn't seem to work in the United States, and therefore there's really not a whole lot of support for that, at least among policymakers that I've listened to.
And am I correct that the federal funds rate is not directly correlated to the mortgage rates because they're more tied to the bond markets?
It's not directly correlated, but there is some influence.
Yeah.
Thinking back to the last financial crisis 10 years ago, one of the tools that the Federal Reserve employed and one that we've reemployed in this current environment is to purchase long-term bonds, including mortgage-backed securities, in an effort to keep the longer-term rates low. Because those longer-term rates, you're exactly right, are much more correlated to mortgage rates. In normal times, the short-term rate has influence throughout the yield curve. We're certainly not in normal times right now. We weren't in normal times 10 years ago. And that's when the Federal Reserve opens up its toolkit and employs whatever tools that we can use to try to influence those rates in response to how the economy is performing.
Do you all, and maybe this isn't a fair question for you to tell me if it's not, but with the mortgage rate so low, why in some areas would the home ownership rate be so low? Like in Tampa, we have, I think, a 49% home ownership rate. Have you all studied any of that, or you mostly studied the other rates?
There's probably some really good information out there. I'm not an expert on that, so I don't want to over speculate. There's so many things that tie into home ownership rates in different areas.
But it definitely ties in, it definitely correlates with consumer spending, right? And so consumer spending is a big part of our economy. Go ahead, I'll let you speak.
No, it's consumer spending. It's also household wealth. It's also just overall cost of real estate. And think about what the home ownership rate in a place like New York City is. So New York City certainly isn't a place that you would think of as being not a center of wealth in the country, but still there's so many different things that affect home ownership rates. Mortgage rates being one small part of that.
Just a reminder for anybody who's watching, welcome and thank you for watching Café con Tampa online. We hope to be meeting in person again soon, but that's going to be at least June, maybe July. We'll see. But in the meantime, we're keeping the conversations going through these online interviews. If you're watching live, and you're watching on your phone, you can post a question below the video feed, or if you're watching on a computer, you can post it to the right. We try to get to as many questions as we can, so feel free to ask whatever you want, and we'll try it. So what's your general take of the economy in Florida and the economy, of the country? And do you guys have any numbers yet, or does it lag by several months?
You've identified a big problem. The data traditionally lags. It's backward looking, so we know kind of where we've been. The data haven't caught up to capture everything that we would like to have to measure the impact of the COVID-19 response on the economy. But the data that we do have in hand is pretty staggering. The employment report came out last Friday, showed over the last couple of months, we've lost close to 30 million jobs. Employment rate back over 15%, which is much higher than it was during the Great Recession. And that unemployment rate, we call that the headline unemployment rate. There's a broader measure of unemployment that takes into account people that are working part-time but would rather be working full-time. It also accounts for people that have stopped looking for jobs because they don't think there's a job out there that to be had. If you incorporate those data into the unemployment rate, it's actually over 20%. So again, much higher than it was during the Great Recession. And the fact that this has happened just in 2 months just shows you what an incredible shock our economy is going through.
And do you think this is a national number? Do you know what the Florida number is in comparison?
Not off the top of my head, I don't.
Okay.
I don't have that.
Sorry, I'll put you on the spot, and I don't expect you to have every number in your head. So I appreciate all the information that you're bringing today. When was the last time that the United States faced a 15 or 20% unemployment rate? You said not the Great Recession, but what was the last time?
Looking back, it would the nearest that I can come up with is right after World War II.
And do we have any idea? What was the unemployment rate during the Great Depression? Do you know?
Well, there's a couple of different measures. Of course, the measurement of unemployment has changed a little bit over time. Some of the historical studies that I've seen going back and trying to equate today's methodology with labor markets back in the early 1930s, the unemployment rate was close to 1/3, so about 33%. But again, that's sort of a I don't want to say it's a guess, but it's an estimate based on research.
Do you have any idea, based on the modeling that you're looking at now, if you think the real number might be around 20%, how much of that will come back once the safer at home policies are taken away?
Again, a great question, and knowing the answer to that question really kind of helps put some parameters around how bad things are going to get. So I'm going to answer that in two ways. One of the things that we do at the Atlanta Fed and other Federal Reserves around the country, in recognizing that data is backward looking, we get out and we talk to businesses and community leaders on a regular basis. You had mentioned our branches in Florida, the one in Jacksonville and the one in Miami. We have people who work in those branches whose job it is to go out and talk to businesses and ask them how the economy is performing in their area, what their experiences are, what their hiring expectations are. And what we've picked up over the last couple of weeks is that layoffs and furloughs seem to be plateauing. That's a positive sign that these numbers might not get worse. On the side, we're not hearing a lot of stories about rehiring. And so the second part of your question is, how is the opening going to have an impact? What we're seeing is a lot of cautiousness, not only with businesses and how they're planning to reopen, but consumers and the businesses that they're going out to. Excuse me, they're being very cautious. So we just can't expect the economy to open up and everything to get back to normal anytime soon. And something that President Bostic of the Atlanta Fed has said several times is that the recovery of the economy is going to follow the path of the virus. So the sooner that the public health crisis is dealt with, the faster the economy can get back on track. And the last thing I want to say about this is thinking back to where the economy was in February before the impact really started to be felt. The economy is performing very, very well. And so what we hope is that once we get a handle on the public health crisis, once businesses have reopened and consumers feel confident and safe enough to start getting out and doing the things that were doing before the pandemic hit, that the economy was in pretty good shape and should recover relatively quickly. The longer it goes on, the bigger the risk to some permanent damage being done.
I'll use a paraphrase, and sorry, I won't get this exactly right, but I remember during Alan Greenspan's time, he said, this is a gross generalization, but he said something like, I'm not using the old methods of measurement. I've got new measures of measurement because it's kind of a new economy. Are there, in this current situation when the data is lagging, what are some of the key measures that you all would look at? Like, what are some of the indicative measures that you would look at to see, to determine the health of the economy?
So there's a lot of really great work that's being done by my colleagues in Atlanta and other Federal Reserves across the country, and really in other universities and think tanks that are trying to measure the overall impact. I invite you and your people that are watching to visit our website. We just posted something new called the Weekly Unemployment Claims Tracker, the much higher frequency data. The employment report that I referred to a minute ago, it's monthly data. So we get the report from the previous month. So we got April's report the first week of May. Unemployment claims measure how many people are signing up to receive unemployment for the first time. And so you can imagine those numbers spiked incredibly, went very high beginning towards the middle of late March and into April. And those will give you a better indication of how the labor markets are performing. That we have at the Atlanta Fed, my colleagues in the research department developed something called GDP Now. And what that does, it measures, so let me step back. So GDP is the broadest measure of economic activity that we have. It's released by the Bureau of Economic Analysis on a quarterly basis, and it has quite a bit of lag to it. So we got first quarter GDP, which is January, February, March. We got that number at the end of April. What the tool GDP Now does that I just referred to, and you can find this on our website, it takes the incoming data, feeds it into a model that measures GDP in real time based on the data that we have in hand. So we have sort of a running estimate of what gross domestic product is, again, the broadest measure of economic activity that we have on a regular basis. So for the first quarter, we know that the economy contracted right around 5%. The data that we have in now, according to GDP Now, the tool that I mentioned, has the economy contracting 35% in the second quarter. Wow. That's a staggering number. I mean, it's hard to get your arms around how big of a contraction that is. And again, that's a quarter to quarter percent change annualized. So,
sorry, that's comparing to the same quarter last year, or from the already 5% down to the.
It's comparing to the previous quarter, but it's annual. So it would be, what would the growth rate be for the entire year if you just looked at this quarter?
So we were already down 5%, and now we're down another 35. Is that what you said?
And so we're definitely in the deepest recession that we've been in for really since the Great Recession, the Depression. But the comparisons to the Depression, we want to be so careful about saying that because, again, there's nothing fundamentally wrong with our economy. We basically shut things down in response to a global pandemic crisis. It was something that needed to be done to make sure that lives were saved, and the people that are out of work are basically sacrificing for the greater good. That's the way that we like to think about it. And the help and the benefits that we can give those people until the economy can get back on track is so important. So
how would you predict what jobs are not coming back, or if you looked at I don't even know if the fourth quarter last year is a fair comparison, but if you looked at it some prior quarter compared to, let's say, third or fourth quarter this year, how would you be able to predict what that would end up being? Any way to do that?
That's a great question. I wouldn't necessarily go back and look at previous quarters and try to find a trend that was going on in the economy before this happened. I would be more, it's going to depend on basically how businesses and how consumers react if there's any permanent behavioral changes that are seen. So for example, I'm working at home, you're working at home, so many other people are working at home. How permanent does that become? Is that something that more businesses are going to be doing in the future? We're seeing some indications that might be the case. So what's the impact of that going to be on, so for example, I work in Midtown Atlanta. There's a lot of restaurants around there. Is that going to mean that fewer office workers not going to restaurants as much as they used to is going to have an impact on that part of the economy, a permanent impact? It's one example of, we're just going to have to see how this kind of plays out. But the industries that are being most hardest hit now, of course, are retail, travel, and tourism, the two biggest ones. And it's just going to depend on what kind of permanent behavioral changes emerge from this experience.
So like one way of looking at it would be let's say you took a manufacturing company in the medical products. So if selective surgeries were stopped and now they're going to come back, in theory, all those jobs would come back. But some restaurants are shutting down completely. You know, Sweet Tomatoes nationally shut down, so those jobs are not coming back, and it may take time for new restaurants to open or for those folks to find jobs in other places, right? And is there any kind of predictive tool that people use to try to figure out what employment would be like at the end of the year?
There's no specific data tool that I know of. The best thing that we could do is, I referred to before, how we go out and talk to businesses and try to figure out what their plans are. And again, trying to get at the answer, the question, and it's a great question, is, you know, the changes that we're seeing in the economy, how many of those, how long is it going to last, and how many of those are going to be permanent? There's really no way to try to.
Is there anything?
I shouldn't say there's no way to model that kind of stuff, but it's incredibly difficult.
Yeah. Sorry to ask you all the geeky questions.
No, I love it. This is great.
If anybody has any questions, you've got a couple minutes. You can still ask a final question. I want to ask you about the dollar. Well, and I also want to ask you about the Florida economy. So tell me first, is there anything special about the Florida economy as compared to other states that you think we either can ramp up as an opportunity or that we might see as a threat?
Opportunities and threats are difficult to say. I will say that mention that one of the industries that are being most affected is travel and tourism. And there's a lot of people, including myself, that like to go to vacation down in Florida.
Yeah.
And, so again, it's how soon does that come back, and does it come back in the same form that it did before February?
So let me ask you about in the last couple minutes, let me ask you about the dollar. You know, I lived in Singapore several years and traveled around the world. We're lucky that the dollar is still the international currency, right? And the petro currency. Can you explain to everybody what the importance of that is to what the Fed does and our economy?
Well, as far as the dollar being an international currency, the impact on the Federal Reserve, I would say it's not something that we concern ourselves with in the following sense. The mandate that Congress has given us is to focus on the U.S. economy. So when we decide policy rates and other things that we use, the only concern that we have and the only priority is how it impacts the U.S. economy. The fact that the dollar is an international currency, it's used all over the world, the decisions that the Federal Reserve makes, and in addition, just overall how the U.S. economy is performing has a great impact on other countries. But in the deliberations of Federal Reserve officials, it's not something that goes into the decision-making process, but we all recognize it does have an impact. And so the kind of coordination that takes place at the international level, it's more of an exchange of information rather than coordinating policies, because like I said, our concern is the U.S. economy.
Let me ask, we got one question. This will be the final question of the day, and it comes from a banker in our area, a very well-respected banker. The question is, what do the models say on the impact on inflation or deflation will the $3 billion in stimulus package have?
Right now, the models are not predicting a spike in inflation. The economy is, when you have a GDP that's contracting 35%, we're more concerned about deflation than inflation. But the money that's being put into the economy is being, it's basically money that consumers would have had if they had been working. So the biggest concern is not necessarily the money that people are getting through stimulus. The bigger concern longer term is the debt that's going to result in. And we know through history that the higher the debt, the more pressure is on inflation. But to date, we really haven't seen any big impact.
Great, thank you. I could sit here and ask you questions forever, but I promised you 30 minutes. Any final thoughts or advice, insights?
No, just we're doing everything that we can possibly do to help the economy through this crisis. You know, people in Florida and around the 6th district, keeping up with things that are on our website, the data tools that are out there, the information that our president is sharing when he's out speaking is a great way to keep up with the economy and keep up with what the Fed's trying to do to help us bridge this gap until we get to better times.
Great. Well, thank you so much again, and look forward to seeing you the next time you're back here in Tampa. Hopefully your son will come to the University of Tampa, and we'll see you more then.
Yeah. Thank you.
All right.
Great having. Take care.